It's a win-win situation for the buyer.
Now, are you implying, though, that if the buyer comes in and offers a price above the sale price, can the buyer utilize those funds for a down payment as well as closing costs?
Good question. No, they must have the down payment. Now, as we said earlier, the down payment can be in the form of a gift, but they must have the down payment. So no matter how you cut it, if it is a $200,000 sale price, there must be $7,000 invested from the borrower's funds.
Now, it's been my experience, though, that there are three major funds needed: down payment, closing costs, and reserves. Most underwriters are going to want to see that after you go to closing, you're not cash poor. You have some money to fall back upon if you fall upon hard times, you lose your job or whatever. They want to see that you have some reserves. What's been your experience with that?
In general, fortunately, there hasn't been much pressure on reserves on these government-insured loans. So I've seen them just recently with a minimum amount of reserves, meaning a few $100, $100.
Not even one payment?
Not even one payment. There's also, when we were talking about the spelling myths, there's also that myth of, okay, they need at least 3 months of reserves, 3 months worth of principal, interest, taxes, and insurance. So if it's a $1,300 payment, they need $4,000 after closing, and that is not the case.
Do you find that it's more likely to be approved, the loan to be approved, if they do have a substantial amount of reserves, or is that play into the role at all?
Good question, and obviously the more reserves they have, the easier it will be for them to be approved. So if they have 3 months or more, it's just going to make it easier to be approved by the lender.
Now, you had said something, I want to go back a moment to when you said that the lender does an appraisal. Is that the same thing as an assessment on a property? A lot of people get that confused. What's the actual difference between the county assessment and the appraisal that the lender does?
Appraisal is market value of the property. So it's called a market search. So it's based on similar properties that are located near, as close as possible to the subject property, to the property that the first-time buyer is buying. And that is similar to the model of that subject property. So it is different from an assessment. Although when county assessors go out, they do look at what is sold and settled also, but you're going to see a difference. So it is true market value of the property based on what is sold and settled in the last 90 to 120 days is probably a fair assessment.
What about, let's talk about timing a little bit. Right now we know we're in this housing crash. We know property values are greatly depressed. We know sellers are selling their properties for the lowest they've been in many, many years. Also, interest rates. Interest rates are at lowest point they've been in 40 years too. What's been your experience with, how do you feel right now about buying at this very moment? Is it better than ever, or do you think as though maybe they should wait a couple years, months, whatever?
Mark, it reminds me of over the past, I've been in the mortgage business many, many years, over 25 years easily. And what strikes me, not funny, but what does strike me is that I've been in loan applications over that period of years with the realtor, the borrower, and myself. And the borrower will ask that question. So I've had that question for over 25 years.
Really?
And the realtor 100% of the time has said, now is the time to buy. Now that's 25 years in a row. So I'm not going to break that record.
But realistically speaking?
Realistically speaking, if there was ever a perfect storm for that first-time home buyer to go out in the market and find a home, as in today's market. And what I mean by that perfect storm is we're talking about excellent values for homes. If we look back at 2005 versus today, you're talking in some cases 40 to 50% less than what the values were in 2005.
Seller's market compared to a buyer's market.
Correct. Also, interest rates are at historical lows. They are at historical lows. They've never been lower. And I was thinking about this on my way down today. In 1965, my parents bought a home in Annandale for $32,500.
Wow.
That same home in Annandale is selling somewhere in the vicinity of $550 to $600 today.
Jeez.
In 1965, we were paying 35 cents for a gallon of gasoline. And today, what is it, $2.79 to whatever,
What was the
$3.
interest rate back then?
The interest rates were somewhere around 5 to 5.5%.
Wow.
Today, we're looking at in the range of 4.25 to 4.5%. It's really remarkable that in 40, 50 years, that interest rates are lower than they were 40, 50 years ago. I just find that remarkable when all other commodities have skyrocketed.
It's almost like, you know, I remember or talking to somebody and saying, do you ever look at something and say, boy, I wish I bought that, you know, like 5 years ago or 10 years ago, I'd be in the market.
Sold it.
I wish I never sold it. And that's where you're in today, because you're getting a backwards look of about maybe 10 years, 5 to 10 years, of what property values were back then. And you're also getting the added advantage of historically low interest rates.
Sure, and if we took the last 50 years in this area, my bet is that a minimum of 40 years that we've had home appreciation. So you take 50 years, maybe 42 of those years we've had home appreciation, and 8 of those years we've had depreciation. But 4 out of 5, that's 80%. Those are pretty darn good odds. If you put that same money in the stock market or somewhere else, especially in the stock market, what are the odds of 80% chance of appreciating every year? That's slim to none.
Mm-hmm. Great retirement program for somebody. And oftentimes I speak to people, and I've heard them say this numerous times, I've never regretted buying a property, but I have regretted selling them.
That's an excellent point. That's an excellent point. And quite frankly, I could say the same for me. I know that in 2000, 2001, I sold 4 of my own properties because I felt this is the top of the market. And between 2000, 2001, 2005, those homes literally doubled. And I sold a little home in Vienna Woods for $222,000. 2 to 3 years later, a real estate agent friend of mine who held on to his sold his for like $435,000.
Oh.
So I can certainly agree with that statement that you made.
Do you feel as though, you said you sold early, are there any indications that we can share with our viewers today which would say, hey, you know, now is the right time to sell? Was there any indications a couple years ago before the housing crash occurred, hey, in your experience, that would have been a good time to sell?
Well, in hindsight, it's market activity. There was just too much market activity, and also the financing was just too easy to obtain. So that is what pushed up values, is the fact that about anybody could obtain mortgage financing and could obtain loan amounts up to $1 million, $1.5 million. That just pushed up values artificially. And then there was a frenzy in the marketplace that pushed up values. And then when that bubble burst, it all came tumbling down.
Well, you make a good point getting back into the financing now, and things have tightened up a lot. The qualifying, we hear a lot about ratios, 28, 36, 41, you know, 29. What are they, Dave? What are those ratios, and what do they mean to the average buyer and also the first-time home buyer?
That was something else I was also going to mention about the inability of many lenders to use more than 28% of a borrower's gross monthly income. And just for some ballparks, let's just presume a $4,000 monthly income, $48,000 a year. If we were using 28% of their gross monthly income for their principal and interest, taxes, insurance, homeowners association fees, that would qualify them for a total of a $1,150 payment. Total payment. we have standards that are more liberal than that. That same $4,000 income, if all things are equal, will allow them to make a payment of $1,700 per month. And there's a huge difference between what you could get for $1,700 and $1,100 a month. If you're at $1,100 a month, you might as well be renting, because you're most likely going to be paying somebody else's mortgage. If you can qualify for a $1,700 a month payment, you're in the ball game, and you're going to be able to have that dream of home ownership.
Dave, we only got a few minutes left, but I think Jim has one very more important question for you.
Dave, are there any programs, if you have an individual that has no income, no savings, and no credit, do you have a program that might work for that type of individual?
Jim, that's a very tall order. To make it clear, to be very clear, we can make loans for the individual who has no savings and no income. So I want to make that very clear. So if you have no savings, no income, you are still eligible for home financing. And we discussed that earlier. You need great support from a family member or a friend. With no credit, that's a bigger challenge, but we can prepare for that. In preparation, let's say, I would think in the range of 6 months. So if you're viewing and listening today and you have absolutely no credit, go to Bank of America, put up $300 and get a secured credit card. Go to Chase, put up $200, get a secured credit card. If your parents are trusting and they trust you, have them put you on their account as an authorized user. That will, in a short period of time, create credit scores for that borrower and allow them to achieve that dream of home ownership.
Okay, well, thanks for that, Dave. Well, that's about all the time we have for today's show. I'd like to thank our guest, Dave Oliverio, for the expertise that he has shared with us today. There was really a lot of valuable information that was covered. Remember, if you'd like to apply for a mortgage or have any questions about anything you've seen on today's show or any of our shows, please contact me at my email, jim@jim-perkins.com, or Mark at his email, mark@markrigney.org. For myself, Jim Perkins, and my co-host, Mark Rigney, thanks for tuning in to The Mortgage Solutions, and we'll see you next time.